Welcome back to Count Me In, IMA's podcast about all things affecting the accounting and finance world. I'm your host, Mitch Rochong, and I'm here to preview episode 139 of our series. This conversation features Jennifer Booth, Vice President of Accounting at Lease. Jennifer has over 20 years of experience and, at Lease, has helped implement processes that emphasize training on the new lease accounting guidance. She serves as a technical resource for clients answering questions regarding accounting for ASC 842 and a technical resource to the software design team regarding lease accounting requirements. In this episode, she was kind enough to share her extensive expertise in these areas as she addresses questions about Lease 2021 Lease Liabilities Index. Keep listening as we head over to the conversation now.
So Jennifer, thanks so much for coming on. And according to Lease Query's 2021 Lease Liabilities Index, the average company saw lease liability increase by 419%. How has the COVID-19 pandemic impacted companies' transition to the new lease accounting standard?
Yes, good morning, Adam. Thanks for having me on the podcast. Excited to be here and share the results of our survey with you. Our Lease Liabilities Index was the result of about 950 public and private companies that have transitioned to ASC 842. This is the new lease accounting standard that both public companies and soon all private companies will be reporting under. And so, as you mentioned, our results showed that the lease liability balances increased significantly upon adoption to the standard. This is because many of those balances that were operating leases historically for companies are now coming on balance sheets. And so that old approach of kind of off balance sheet financing for operating leases is no longer available. And so not only has 842 kind of been in the works for a little while to help investors get a better understanding of lease accounting on a company's balance sheet, but as you mentioned, COVID-19 has really highlighted this transition because companies have changed the way that they've been operating in their businesses, and in addition to that, their finance groups are have a lot of significant changes that they're undergoing. Some personnel changes, trying to work from home, close the books remotely, and business changes that they're trying to process through. So I think one of the big highlights was that the standards all were delayed because of COVID-19. So public companies went back, they had already adopted back in 2019, calendar years for 2019, but for private companies or governmental and then soon to be federal organizations that will be adopting, they've all gotten relief. And that was definitely a benefit and much needed from the boards. But many of these organizations have kind of stopped their transition process as a result of the pandemic and needing to focus on many of these other things. And so I think that's going to be problematic for them as the deadlines for private companies and governmental companies are right here for us.
So it almost seems like you could potentially continue to see an increase as those companies start to adopt it, since they paused and now they'll have to start again in the future, right?
Yes, exactly. Right. So governmental entities, GASB 87 is a similar standard to ASC 842, which is what the private companies are adopting. And so for GASB entities, that is already effective. It's effective for fiscal years after June 15th of this year. So they already need to be well down the process. And we've had many discussions with government prospects that don't realize that they either should already be accounting under 87 or soon need to be. And so, I think some of the private companies are a little more aware of the deadlines, but may not realize kind of the magnitude of what they have left to get through on this adoption.
So are there certain industries that were hit the hardest, and why was that?
Yeah. So our results showed kind of the top 10 industries that were impacted, and kind of the top 4 of those, banking was the highest. They saw about 130% increase in the liabilities. And then higher education was about 75% increase. financial services and restaurants were about a 40% increase. And what I see as I kind of look at that is many of those organizations have a number of embedded leases. And so this is kind of at the top of this, we were talking about operating leases. And so historically, many companies may not have as closely identified operating leases and called them out and ensured that they had those identified as leases, because the expense treatment of an operating lease and a service contract was very similar. And so, but you can't do that under the new standards. Under the new standards, while the expense treatment is similar, you have to put all your leases on the balance sheet, operating and the capital, which are now financing leases. And so many companies are realizing that while they may have had a good understanding of their capital leases and some of their larger operating leases, now these embedded leases, they have to look at those. So if we think of banking, there could be ATMs or those counting machines that may be in different banks. Some of these may not have been identified before. You also could have arrangements where you have some type of provider providing a service, but there is an asset being leased in the process. And so you have to go in and identify that. So if you think of from a software perspective, many companies, have everything in the cloud these days. So you have server farms, or you're using that type of thing, that you are entering into a service contract with an organization, but you actually may have some leases of servers or other computer equipment in there that you need to consider and determine, is that a lease that I need to separately call out and identify? So those are a few for kind of those top three. And I think restaurants is interesting because they've shown they had a 40% increase on adoption. And that was before any of the changes related to COVID, right? And so because of the pandemic, we all know restaurants have been hit so hard. And so they are kind of continuing to work through this process for the ones that have been able to, successfully move on. Now we have things like ghost kitchens, or where, it's a new location being set up that may be cooking for multiple restaurants. And so how do you identify those leases of that equipment? How are you appropriately accounting for that? They are going to have a whole new host of challenges that wasn't even in this data, because none of that really existed back, earlier in 2020. A lot of that was just starting to get set up.
Yeah. It almost sounds like you'll need to do another survey with 2021 with all the changes that have happened.
Yes. I think that's on the agenda. And I do think it's interesting. Manufacturing was at the bottom of our top 10. They only showed about a 2.5% increase in the liability. And to me, that's not actually unexpected, because manufacturing companies have really had to focus on their leases historically. When you think about it, you knew you had warehouse leases or a lot of machinery leases and that type of thing. So I think it was a lot easier for manufacturing organizations to identify and call out those leases. And it's been a lot of other aspects of organizations that have really realized during their inventory that they have a larger population of leases than they originally realized.
So were there any interesting findings of the lease liability index that really stood out to you?
Yeah, I think two that stand out to me. The first is just the magnitude of the increase associated with the new standards. So for public companies, our data shows that the lease liabilities increased about 4 times. So from about 60 million to about 240 million on average. And so a lot of that is driven by the items we just kind of talked about. Figuring out these embedded leases. Do you have any additional leases to record on the balance sheet? But I think a lot of public companies had thought they had a pretty good understanding of leases, a pretty good inventory. And then as they started working through the process, they realized, oh, wow, there's a lot more out there than we realized. And so the data that we have for private companies, those early adopters, because their standard 842 is not yet effective for them, but they had the option of adopting early. And so the increase for those early adopters is 13 times. So I think that really highlights that not only do private companies, they may have less resources to be able to work through this adoption, but they may have, as an organization, less of an understanding of those leases are out there. So they may have a lot more work to come than they actually realize. And I think the second item that I can think of that's interesting is, again, kind of related to the pandemic and some of that impact, and that's just rent concessions. So I think we all are aware that with the pandemic last year, so many organizations shut their doors and worked virtually if they were able, or if unfortunately you were, a restaurant or something like that for a little while, you may have had to actually shut your doors. And so many of the lessors offered rent concessions to the lessees. And our data showed that about 54% of the retail organizations were able to receive a rent concession. So they were able to either have the lessor accept less rent for a period or delay that rent. So if that rent had originally been due in May of 2020, maybe that payment isn't due until December of 2020 or May of 2021. And the FASB came out with some guidance that allowed companies to account for these rent concessions and gave them a little bit of relief of accounting for that under 842. Which was great because, even when we think back to public companies, they've been under this standard for a couple years, but especially companies that were using spreadsheets or trying to go through this from a manual process, this has proven that this is not a set and forget it model. There were a number of modifications last year and changes that companies have had to go through and account for. And again, I think that was not expected. And to your point, we'll probably show some interesting data when we update it this next year.
So you've already been talking about the process to do this is complex, time-consuming. The average company, saw lease liability increase by 419%, but there's got to be some added benefits for companies. Have there been some that you've uncovered, that companies have uncovered during the process that you've seen that you can share with us?
Yes, Adam, I can think of three that I think would be good to cover. So I think the first is just the transparency. So many companies are now getting a better handle around all of their leases that they're accounting for. Historically, a lot of that information might have been handled at, a disaggregated level, at a division or something like that. And so now there's a better understanding of those. Maybe if 5 different divisions all were leasing vehicles or something similar, then the company can enter into kind of a master lease for all 5 of those and get some benefits from cost. So certainly better transparency amongst an organization, and that was helpful for the companies that were already under 842 last year, as many companies were trying to figure out, cash flow benefits, where could they cut some operating expenses. The second item is many companies have been able to save money after adopting 842. And this is, again, they just realized what leases were out there. And so if we think of it, we've talked to some customers that this has been heavy on either like a university side or like a hospital or medical side. If you think they may get a new piece of equipment, if they may get the new microscope or whatever the new equipment in the hospital is, and they may enter into a 3-year lease on that. And so somebody in, AP or billing is continuing to pay that lease every month. But then the next year, the new microscope comes out and the department says they need that and they get approval and requisition that. And so, microscope 2 is now in use and microscope 1 is back on the shelf. But the company is still paying for it, or the university is still paying for it. And so it was kind of that loss of correlation between the two groups. They didn't realize in the research department that it was still being paid for, and AP didn't realize that they weren't using it. And so now companies are better able to realize and either terminate leases early or put them to use throughout the organization better, which again is saving money. And then the third thing I can think of is this information is helping companies from a lease versus buy perspective. So one of the reasons historically that operating leases were looked upon so favorably is the associated liabilities were kept off the balance sheet, right? Again, it was just expenses recognized per month. And so now with 842, and the whole point of 842, honestly, was getting those liabilities and assets on the books so that you could look at two companies and whether, one company leased 100% of their fixed assets and another one bought 100% of those, their balance sheet now should look more similar. And so this data is really helping companies go through lease versus buy decisions better. Leasing still will always be an effective financing solution, but it'll help now look at companies and see that transparent information and help companies decide better, should we lease or should we buy?
That makes a lot of sense. So as we wrap up our conversation, Jennifer, what advice do you have for private companies on their journey to lease accounting compliance?
Well, the first thing that I immediately think of is that private companies just need to jump in and start. Through the process, especially as public companies were starting, there was this whole focus on getting an inventory of all of your leases and then trying to figure out how to account for them. And that's certainly important, and companies need to figure out the inventory. But honestly, it's just most important to jump in and start accounting for what you know, right? This will help you determine which policies you want to take. 842 has some practical expedients within it, which are a little bit shortcuts for for the companies upon adoption. So it'll help a company to just jump in, start coming up with these policies, start figuring out what data you need for all of these leases. Do you have this data? Do you need to go back and get it? And so you're working two streams. You're accounting for what you know while you're also still gathering what you don't know. And I think this will also really benefit companies because some companies have realized that there are some classes of assets out there where they do lease accounting or where they lease those assets, but they actually aren't material when you look at it from a consolidated perspective. And so some companies have been able to talk with their auditors and scope out accounting for those. If we think of copiers, those historically many times were service contracts, but there is a physical copier that is usually on the premises. And so, but that may not be material when you think through all the other leases a company has. So working through and accounting for what you have while you're still working on that inventory will help ensure that you can get to the deadline and account for the leases at transition. And I think the second thing would just be for the organizations to realize that they may need extra resources, right? So many companies were downsizing last year, or the finance organizations have really been shifting around, trying to account for many of the changes in the business. And so similar to the revenue recognition guidance, ASC 606 that came out a couple of years ago, companies may need to talk to resources, talk to specialists, and speak with their auditors just to ensure that they're on the right path so that they'll be set and ready for adoption.
This has been Count Me In, IMA's podcast, providing you with the latest perspectives of thought leaders from the accounting and finance profession. If you like what you heard and you'd like to be counted in for more relevant accounting and finance education, visit IMA's website at www.imanet.org.